The UK property investment market has changed significantly over the past decade. For many years, owning a buy-to-let property was seen as a stable, straightforward way to generate income and build wealth. Traditional landlords would buy property, rent it out, and collect the rent as a passive income source, often with the intention of securing their retirement. This model worked well for a time, but as the property landscape evolves, those who are still relying on this approach are finding it harder to stay ahead. The market has shifted, and it has become clear that property investing is no longer the same game it was 10 or even 5 years ago. Several factors are driving these changes, including the introduction of Section 21, rise in interest rates, the influx of large corporations like BlackRock and Lloyds buying up properties, and shifting tenant expectations. The way landlords operate today needs to be more strategic and business focused than ever before. The days of buying a single buy-to-let property and sitting back while the rent rolls in are largely behind us. Landlords must now adapt to a rapidly changing environment, or they risk being pushed out of the market altogether. One of the most significant changes affecting landlords in recent years is the proposed abolition of Section 21. Traditionally, Section 21 allowed landlords to evict tenants without needing to provide a specific reason. While this was useful for landlords who needed flexibility, the government has been moving towards abolishing this legislation in favour of offering greater protections for tenants. Although this is a positive step for renters, it also means landlords now have less control over their tenants. Without the ability to easily end a tenancy when required, landlords have to carefully consider the quality of tenants they take on and how they manage long-term relationships with them. This change alone has made the landlord-tenant dynamic much more complex. Another key development in the UK property market is the increasing involvement of large corporations in residential property. Companies like BlackRock and financial institutions such as Lloyds have been buying up thousands of homes in recent years, increasing institutional ownership of residential property. For individual landlords, this presents a major challenge. Large corporate investors have access to far more capital and resources, making it harder for smaller landlords to compete, particularly in sought-after locations. Corporate players are also able to operate more efficiently, offering tenants higher quality properties and better services, which in turn raises the expectations of renters. For smaller landlords, the competition is fierce, and competing with these large players means being proactive, professional, and on top of the market trends. Interest rates in the UK have been rising, putting significant pressure on landlords who are reliant on mortgages to finance their properties. In the past, low interest rates made borrowing cheap, which allowed landlords to expand their portfolios and increase their profit margins. However, with rising rates, many landlords are now facing higher monthly repayments on their mortgage loans. This can erode their cash flow, making it more difficult to turn a profit, especially for landlords with smaller portfolios. Those relying on a handful of properties to generate income may find it more challenging to keep up with the rising costs. For landlords to remain profitable, they'll need to rethink their investment strategies and adopt to a more expensive borrowing environment. Another major change that's hit landlords is the introduction of Section 24 of the Finance Act 2015. Section 24 effectively limits the amount of mortgage interest landlords can deduct from their rental income when calculating tax. Previously, landlords could offset the full cost of their mortgage interest, which helped to reduce the tax burden. However, Section 24 phased out this relief and restricted it to a flat 20% tax credit, regardless of the landlord's tax bracket. This change primarily affects landlords who own properties in their personal names, which is still the case for the majority of older traditional landlords. For these landlords, the tax changes have been significant, and many are now struggling with much higher tax bills. To mitigate the impact of Section 24, many landlords are considering shifting their portfolios into limited companies. Holding property within a limited company structure offers a number of advantages, including the ability to continue deducting mortgage interest as a business expense. This can help reduce the tax burden and make property investment more financially viable. However, transferring a property into a limited company structure comes with its own costs and complexities, so landlords need to weigh the benefits against the potential drawbacks before making the shift. In addition to these legislative and financial changes, the expectations of tenants have evolved over time. Today, renters are increasingly demanding higher quality properties. Long gone are the days when tenants would settle for anything just to get a roof over their heads. Today's tenants are looking for well-maintained homes, modern amenities, and a high standard of living. This shift in tenant expectations means that landlords can no longer afford to take a passive approach to property management. they need to invest in their properties, ensuring that they're in a good condition and meet the demands of modern renters. This means making upgrades, maintaining regular maintenance schedules, and ensuring properties are well kept in order to remain competitive in the market. These changes all point to one critical conclusion. The traditional model of being a small-scale passive landlord is no longer sustainable for most investors. Property investment today requires more active management, a business-minded approach, and a strategy for scaling up. For many landlords who once relied on the passive income from just one or two buy-to-let properties, the landscape has become far more competitive. Simply owning one property and letting it run on an autopilot won't provide the same returns it once did. Instead, property investors today need to think about scaling their portfolios in a strategic and sustainable way. This means treating property investment as a business, not as a hobby. This involves making sure you understand the financials, investing in quality properties, and constantly evaluating your portfolio's performance. The key to success today is growing your portfolio so that you are not over-reliant on a single property. Diversification into HMOs, houses in multiple occupation, for example, allows you to generate higher rental yields from multiple tenants in one property. It's no longer just about owning property, it's about building a property business that can withstand the challenges and changes in the market. In conclusion, the UK property investment market has experienced major shifts over the last decade, and traditional landlords who fail to adapt will find themselves at a disadvantage. The introduction of Section 21, the rise of corporate investors, rising interest rates, and tax changes like Section 24 are all factors pushing small landlords out of the market. Additionally, tenants now demand better quality properties, further raising the bar for landlords. To stay competitive, landlords must treat their investments as businesses, scale their portfolios, and invest in higher quality properties to meet tenant expectations. The days of buying a property, sitting back, and letting it generate passive income are behind us. Property investors who can adapt to these changes, think strategically, and embrace a more professional approach to property management are the ones who will thrive in this evolving market. I hope you got a lot out of this video. As always, thank you very much for watching. I appreciate you for being a subscriber, and I'll see you on the next one.